All right, everybody. Hey, what is going on, everybody? Welcome to Note Night in America here on February 7th, 2022. Glad to have each and every one of you. Yes, Robert, a little Def Leppard to kick the night off. He says, I'm down. I'm down as well. It's hard to beat a really good greatest hits album. That's from the Vault, for those that are interested in there. Somebody asked me about that earlier today, and it is actually one of my favorite albums. It reminds me of being a senior in high school in 94, 95. But anyway, guys and gals, welcome to Note Night in America. Honored to have each and every one of you here, whether it's your first time or your 100th time. We're jacked up, and we're going to have a good time tonight. Might be a little scary, all right? It's not meant to be a little scary. We're meant to throw some sugar on it, baby. We're going to find some good stuff for you to get you excited. Yes, I'm hot and sticky sweet, baby. But anyway, we're here to really help you guys out. This is your first time to Note Night in America, first time watching it, whether you're catching the replay on YouTube or on the live stream. Glad to have you. We are monitoring our YouTube channel, so if you're watching this on the live stream, feel free to type in questions. We'll gladly answer them as we can. But all of these are recorded. They are on YouTube, and you can also watch them anywhere that you listen to podcasts out there. So once again, excited to be here for the 12th year in a row. Just crazy how time flies out there, but actually the 11th year, not the 12th year, 11th year. Make sure, though, if you listen to podcasts like 26% of Americans, check out the Note Night in America podcast. Please, if you get a chance, leave a review. I'd love to see a review online about that. We're always glad to hear from our listeners, as we have listeners in over 130 different countries across the world. You can always go to weclosenotes.tv. That'll get you to subscribe to the channel and let you know when things are popping as well there. But once again, all of our podcasts, including the Note Closer Show podcast and Note Camp podcast, are all live and available on any podcasting platform out there. And so just we just launched the NoteCamp.live podcast, which is it's a series of replays from the Note Camps of 2020 and 2021, and just really amazed at the amount of downloads that podcast. Of course, the Note Closer Show podcast is over 1 million downloads. So thank you for listening. Thank you for subscribing to the channel. I'm always excited to be here. I literally turned down a steak at the best steakhouse, a fat ribeye from the best steakhouse in Austin, Texas tonight, from a good friend, to be here with you all night, because I want to bring the steak to you tonight, because I think it's going to add some value to what's going on, maybe quite a little fear, and give you guys some options with what's the craziness going on in the market now. But I wanted to let you know of a couple of things that are upcoming here. Mark your calendars. Our next Note Weekend class is scheduled for February 19th. That's in 2 Saturdays from now. Learn the basics of note investing. You can get to noteweekend.com. It's normally $99 is what it usually is. And we are running another special on it. I think when I looked at it, the sale price was at $9 a ticket right now, and it goes up by every purchase. So if you want to spend a day with me going through the basics, the Cliff Notes version of note investing, figure more about this note stuff for me or not, check it out, noteweekend.com, and get signed up tonight on that special sale. And I've had a lot of questions from people. People have asked, was it a Wagyu steak? It was, tell you what, it was my favorite place called Lambert. And I've had Wagyu steak, and that's okay. But my favorite place, steakhouse in Austin, Texas, is Lambert's or Eddie V's. And you can get both of those there, and it's just phenomenal. But anyway, I've had a lot of people ask me questions about how to wholesale notes, from, hey, how do I individual notes, or how to wholesale a portfolio of a pool of notes, stuff like that. And so we have not taught a wholesaling class, just a class strictly on wholesaling notes, for years. And I was like, you know what? It's time to do it again. So with the questions popping up and people really trying to do things, we are rolling out. Get this, drum roll, please. All right, drum roll, please. A master class. It's a 1 day from 9 a.m. to 1, 2, 3 o'clock in the afternoon, depending on how many questions we get, and going through some things. We're excited about this. I haven't taught a wholesaling class in a while, but a master class in wholesale notes, Saturday, March 5th, from 9 a.m. to 1, 2 o'clock in the afternoon, whatever. We're going to cover a bunch of stuff on wholesaling notes, wholesaling pools of assets. We'll show you how to control millions of dollars for as little as $10. We'll show you how to take $100 out of your self-directed IRA and turn it into thousands of dollars in profit, tax-free, tax-deferred. We'll show you how to build your buyer's list. We'll help you protect your sources. We'll go through all the contracts, the paperwork that you need to make yourself an effective wholesaler. No, we don't want to turn you into a daisy chain or a joker broker. We're really going to help you out do this stuff. But literally, it's $99 normally. If you're watching this tonight, if you're watching this on the replay, if you go to wholesalingnotes.com and type in the code NNA, that's all caps NNA, that'll knock the price in half for you. And we're going to limit this to roughly 50 people only. So this is the first place I've announced it here is on Note Night in America for you guys. If you are part of the WCN membership, our monthly WCN crew, you've got a ticket to it already. So you don't have to worry about signing up for it if you're part of the WCN crew at $97 a month. It's included. Another bonus for you guys that continue to show up each month for you. Yeah, Larry, Shelly, some people are pretty excited about that. So it's a one-day class. I am really excited about this class. Steph was even like, oh my God, you're teaching a wholesale class? I'm like, hello, we wholesale deals all day long. Why not? Time to start teaching it. So as a facet for you guys, some of you guys are a little nervous, nervous Nellies to pull the trigger yourself or don't have the capital, a little nervous about going and raising capital. Hey, wholesaling is a great way. Well, Dimitri, you're part of the WCN membership, if I remember correctly. So if you get paid before that time, we can jump on a call. So it's totally fine. Before now and then, if you're part of the WCN membership. So once again, wholesalingnotes.com. I was very surprised that URL was available, but I'll pick it up. Wholesalingnotes.com. There and code NNA for Note Night in America for you guys. And that will be a fun class to teach here in a couple weeks. So yeah, Larry, it's the weekend after you're in town for your one-on-one. So we'll have some good stuff there for you. But anyway, moving on. Any question about this stuff before we get rocking and rolling here tonight? Now, our topic tonight was all about beating the bank, right? And we did a little discussion on this a couple weeks ago about filling your cup. Okay. And I've gotten a lot of requests from people, investors, friends, ask me what I think about the market. What am I, with this crazy inflation rate that came out. And so I thought from doing some research and doing some things, and I've been working on some, people don't know, I've been working on some stuff over the past 6 months on the down low that I'm really excited to share with you tonight. So it's an opportunity, but we all know your dollar is getting less powerful by the month, right? They came out this first part of January 11th, January 12th, talking about inflation rises 7% over the past year. It's the highest increase since 1982. Usually it's at 2-3%, but boom, it's up at 7%. And there's a lot of things that are getting more expensive. You know what I mean, everybody? I mean, you don't have to look far to see something. So I wanted to pull some information. If you look at 1970, what's a cup of coffee? I mean, God knows the average cup of coffee isn't just $2.19. Maybe it is if you're at the gas station, the truck stop. Or here in Texas, we have the Buc-ee's. So you can get a cup of coffee for cheap. But most of them, it's over $2. $1.59, they say. How inflation has changed the price of coffee over time. So they say it was originally 25 cents in 1970. It's at least $1.59 now. Okay, that's great. I don't usually get a lot of coffee. I don't buy Starbucks. I've got a place here in town that we go. We usually buy a big bag of beans and roast those or have those roasted for ourselves. So I thought, well, let's look at water. What does water cost? Okay. This is the scary thing. If you think about bottled water, if you're buying a 20-ounce bottle of water, on average, a 20-ounce bottle of water costs approximately $1.50, right? So it's about the same. But when translating that into gallons, water costs approximately $9.60 per gallon on average when consumed in bottled water form. Okay, I was down for the holidays with my mom, spent some time with her over Christmas and New Year's, stuff like that. And she's like, "Oh, hey, I need you to go fill up my gallon buckets." I'm like, "Okay, what's wrong with the tap water?" "It's okay, but I like clear filtered water." I'm like, "Okay, what's this going to cost you?" "Oh, it's going to be 25 cents for 2 gallons. So she's got one of those little water you pull up like you see at the grocery stores, 25 cents, fills up a gallon or 2 gallons of water. Okay, great. That's great. She's using that for coffee and drinking water versus out of the tap. I think she's on a well. But think about that. $9.60 per gallon is always, that's 4 times what a gallon of gas costs here in Austin, probably 2 times what a gallon of gas costs in California. But we have inflation. And if you think that's the only thing that's kind of crazy, look at all this stuff that was up in 2021. Now, that's a pretty big thing, all the way down from pharmaceutical preparations all the way up to automobiles and automobile parts retailing. Like used cars is usually a good measurement of inflation. But what I did is I broke this chart down so it's a little bit easier for you all to see. So on the lower end, you can see things going up like loan services for 7.3%. Dairy products, your gallon of milk is going to go up by a little bit. Air transportation and freight up by 6%, hasn't changed much. Inpatient care, health and beauty retailing, including optical goods, it's about the same. You start getting up there, soft drinks. Woo, that Coke is going to cost you a little bit more. Cigarettes and tobacco, 8.5%. Food and alcohol retailing, the bars, right, and restaurants, that almost 9% inflation. Plus, they can't get anybody in there to work either, too. Now, I stopped at 8.9% because that was really kind of the big difference. Now, if you flip it to the next one here, all right, I don't want you guys to cry. It can be a little scary a little bit here, everybody. All right, hang on. Some of these numbers are crazy. Like equipment parts are up by 12.8%, footwear, jewelry, accessories, 16%. Portfolio management. If you've got a portfolio of some sort and the stock is going to cost you probably around 16% more, is increasing fees. Water transportation or freight, truck transportation or freight. We all know it's getting expensive, like up an auto and other parts there. Fresh fruits and melons, 16.8% increase in inflation. This is crazy. Yeah. German Claiborne says, wow, this is really crazy. Fresh and dry vegetables, 20% more. Meat's costing you 20% more. Airline passenger services, 20.9%. Residential natural gas, 25.3%. Processed poultries, 26.2%. That's why you see like Wingstop going to chicken thighs, because it's getting expensive for those chicken legs and chicken wings, which originally nobody wanted. Okay. Fuels and lubricants retailing, industrial chemicals, jet fuels up by 52%. It might be a rise while Frontier bought Spirit Airlines today. Home heating, oil and distillates there. Number 2, diesel fuel, 54.9%. Gasoline, 65.8%. And as like I said before, automobiles and automobile parts retailing, especially used cars, usually a good sign of inflation, up 72.4%. We've seen this like when I was down at my mom's house, which is just down in Corpus Christi, Texas, about 3 hours south of Lamar. The dealerships there, it's not like Dallas or Austin or Houston or even San Antonio. I mean, where she lives in Aransas Pass, it's a small little community, maybe 10,000 people. And the dealership's like, well, you can take it or leave it. I mean, what used to be a truck that was like 20,000 decked out Ford or GM, they're selling for 40, 50 now or 60 because we don't have chips. The cost of supplies have gone up because the demand's still increasing, but the inventory has gone down. We can thank part of the blockade, but part of it is to deal with COVID and everything else. Now they see this thing dropping. Well, before the last quarter, like, oh, we thought we'd see a normal thing. Well, now people are a little worried about this. Can we agree to that? If you look at other things out there, we all know real estate has been increasing, but if you look at where they're expecting home price forecast for the year, they expect some of it to go up on average of about 5% across the board. And when they looked at the National Association of Realtors, Zelman, HPES, the Mortgage Bankers Association, Freddie Mac, and Fannie Mae, they still think we're going to see increases on average of about 5%. Other areas will be extreme, but I also think a decline when you compare to what they talked about the last couple of years, that number has dropped. And we're already starting to see, especially home builders across the country, a lot of the new listings in markets like Dallas and Houston are not from homeowners. It's from builders having to list properties and trying to get it sold. And they're making some big price drops in areas out there. Maybe you've seen that in your area, maybe you haven't. Now, looking at I found this chart quite interesting. If you think about inflation, what it would cost today, and some of you guys will find this. And I'm going to tell you, you may not like these apples, okay? So if you had $100 in apples back in 1799, okay? And this was the analogy. Well, first of all, we talk about it being, 230 years or 220 years, that apples are long gone, But if you bought $100 worth of apples, to get the same amount in today's dollar, it would cost you over $2,100 today to buy 100, basically what bought you $100 worth of apples back in the day. $100 apple, that was like almost a forest. Today, you got to do a whole lot more. And very slow, but you see, especially in the last 30 years, actually if 79, that's 21, actually last 40 years, how much more expensive things have gotten. And we all know salaries have not kept up with that. Minimum wage has not kept up with that, but it has gotten dramatic as things have gotten. Yes, sometimes they say increase in wealth, increase in salaries is good because you're spending money going from there. But who's really getting crunched? Well, we all know homeless is increasing, and so we all know the poor are not doing well. And then we also the middle Americans is the ones that are really seeing the biggest impact, getting squeezed from the bottom side, where you need to make, you need to be making 20, 25, 30 bucks an hour just to get by in most major cities. All right. If you're making like $20 or less in Orlando, you're at the poverty line for the most part. And that poverty line keeps going up, but the wages have not increased, income has not increased. And I think it's why you see a lot of people not going back to, basic service jobs, because they're like, look, I can do more, or heck, the government's going to pay me to stay home, which I hope that's not the case, but you get what I'm saying. Now, looking at the average, this kind of gives you a bit of a chart showing you how the inflation has rose over really the last year. I mean, last year inflation was at 1.4, 1.7, and it's dramatically increased as supply chains have gotten stuck. Like I said, less goods, increased demand, increased prices, increases inflation on an average across the board. They said we might be at 8%, maybe at 9%. Prior to the end of the year, they were saying, oh, we'll be at 2 or 3% by the middle of the year. And some people are saying, no, that's not the case. A lot of comments like, no. You can predict that you can hold out one hand and do something else in your other hand. You know what you're going to do, and your other hand's going to fill up faster. Okay. When you look at the cost for building costs over the last couple of years, they're increasing. Cost of non-residential buildings, residential skyrocketing, non-building infrastructure skyrocketing. So cost to build houses, as my buddy Jason Bible likes to say, if you thought property was expensive now, wait 10 years, wait 5 years, okay? And looking at the average cost of materials for the same house in the past 12 months, look at this. On average, it's become more expensive. On average, it's 26% more to build a house. 26% more on average to build the exact same house a year ago. It costs 26% more today than they did a year ago. It's ridiculous because of the cost of goods. Lumber is rising, imports and all that stuff are going up. In some cases, it's 50% or more. This is the thing that scared me down here. 15% or more in 15% of the country. All right. That's a scary number. And if you look at inflation, we see a big increase in rents are climbing, which is kind of a good thing for us as real estate investors if you've got rental property. I've seen market value on a couple of our notes go from $600 to $1,000. Here in Austin, Texas, we've seen rents increase on rental properties an average of 35% to 40 to 45%, to something that's 50% increase in rents. People can't afford that a lot of times, and so you have people getting in trouble. And it kind of rolls in with the same fact. You have this kind of snowball of issues taking place. And this was put together by Zillow and Yardi. Yardi.com is you guys aren't familiar with Zillow. Yardi is actually located here in Austin, Texas. They're a company that does some rental software that we've used in the past for notes. So it may linger because rents are climbing. So the question many of you are asking, like, oh, crap, where should you put your money, right? Well, let's talk about this. So obviously with the banks, people talk about, oh, should I put money with the bank? Well, if the average CD rate right now, this is actually my Google. When I ask the question, it literally auto-populates. So you can tell that people are literally Googling this right now, okay? The average one-year CD has a rate of 0.17%, not even 1%. We're talking, that's the average one-year CD. The average 5-year CD has a rate of 0.31, and the average 1-year jumbo CD. Now, a jumbo CD is $100,000. Okay, a 1-year jumbo CD is at 0.19%. Now you could go to a 5-year jumbo. All right, is anywhere from 0.32 to 0.79%. Still not 1%. 0.79%. 0.8% for a $100,000 jumbo CD that you're going to top for 5 years. Oh, man, somebody is just, oh. And here's the thing. When I was a banker back for Bank One and JP Morgan Chase back in 2003, 2004, we saw rates at the 4.25, 4.125 stuff. And now interest rates were higher, and obviously the Fed they're talking about the Fed increasing rates a couple of times, but they chose to stay, level this time, right? Yeah, Shelley goes, wow, a jumbo 5-year making not even 1%, a third. So now I also asked the question, all right, 0.06%. That is the answer. I asked this other question. That was for a CD. What's the average CD right now? What's the average national average interest rate for savings accounts? It's 0.06%. Woo! Now, I just find it funny. Many online banks have savings rates higher than the national average. The higher the rate, the more interest you'll earn on your savings. Duh, common sense. But the point is, what are the fees, right? If you're getting a fee, if you got $1,000 in a savings account and you're not making 1%, which would be $10 on $1,000, if you got a fee for $12, that eliminates the interest. Don't think banks are stupid about that with annual fees, because they're designed that to basically say, oh, we're going to say we're going to pay you some interest, but we're not going to give you any interest. Okay. Okay. So here's another thing. So when you start looking at numbers on this, you start figuring this out. Where's it going? So if you, like I said, if you had $100 in your savings account, making 1%, you basically have $101 at the end of the year there for you. Okay. There's so much, as German says, it's so much money. There's so much money parked right now with nowhere to go. That's scary. Yes. Now, if you think about that same $100, but with what the numbers are going on right now, if you have a 7% inflation rate, your $100 is now, what's it worth? It's not worth $100. It's worth 93 cents or $93. We're literally burning a hole in our pocket. And you start figuring in that over the last couple of years, average inflation is 3 to 4% annually. You getting a 3% or 4% pay bump is just keeping up with inflation. You're not really getting ahead for those that are working out there. So what are some of the things you can do to protect your money? And it was funny, when I pulled this information, it literally auto-populated. It was the #1 search engine, investments that are beating inflation right now. And there's an article out there. And I'm not an accountant or an attorney. This is purely for information purposes only. I'm not here to give you any financial advice or stuff like that. You still want to talk with your attorneys and accountants, stuff like that, like I said. But these are some of the things they talked about that can beat inflation. Some of the investments out there. They talked, the first thing was gold, because when gold increases, it's a natural thing. It increases in price and value, but gold doesn't pay you a dividend. It doesn't pay you an annual interest rate on that stuff. It's also kind of hard. You can't walk around with a lump of gold and try to get anything done with it, right? I mean, you could, but you're probably going to get shot or robbed or beaten over the head. Commodities. Okay, when we have increase in inflation, commodities are often a great place, but you got to have quite a bit of money to play in that space. All right. They talked about having a 60-40 stock bond portfolio. So you're nice and balanced there. But when they were giving the article, when they were giving these numbers or where to do it, I was like, that's not keeping up with it. It's barely keeping up with it, if not losing money. They talked about real estate investment trusts as being not a bad aspect of things like that, where there's obviously a fund going out and buying properties and managing the rentals and paying you a pretty good return on investment, which is not bad. The S&P 500, they talked about that as well. But #6 was real estate income. And they said, listen, that's a great way, obviously, to exceed or beat inflation or keep up with it or exceed it. And there's obviously a variety of different ways you could be a real estate investor. But as they said, the con is you often have to have a huge amount of upfront money to play and make anything happen. And then you've also got to be very active in a couple of places. Okay, fine. It makes sense. They talked about an aggregate bond index. Then I found this kind of interesting. They then talked about leverage loans or CLOs, which is basically, it's a portfolio of, guess what? Subprime loans. Okay. Yeah, you should invest in a portfolio of subprime loans because they have a high level of debt or low credit score. The borrowers they make these things out to. These loans also have higher risks of default and therefore are more expensive to the borrower. Which I found that kind of contradictory, but that's okay. We're in the note space. Back in 2008, we bought a lot of non-performing loans, and not all of them were subprime loans, or a lot of them were A-paper loans. But they talk about these leverage loan packages. You can be a portfolio, and the average weighted rates around 6 to 7%, and they can kind of go up as interest rates go up, because their interest rates go up. They're making a higher interest rate loan to the borrowers and that kind of stuff. So it's basically investing kind of in what they were talking about, subprime loans, whether it's both residential or commercial, which is kind of fun. Number 9 was tips as a treasury, inflation, protected securities. They talked a little about that, but I'm not going to even go into that. But what I found always funny was number 6, real estate income. And I think we've seen that as rents go up, if properties go up, if you're owning the property or you invested something, we've seen that. We've seen an increase. We've seen as values go up, you're sitting pretty good on the property value. If you own a note and the value goes up, that's a good thing because now you've got increased technically equity above what the borrower owes you, which makes it that equity makes it something that the borrower wants to keep. Now, if they're upside down in a negative equity position, that's usually something that they're willing to sign over to you or potentially work with you to help them modify their loans or reset. But if you're buying debt at a discount, it works out pretty well. So what are some of the options? When we start talking about some of these real estate investment, you could literally take your money out and lend it out on like a hard money loan or mezzanine loans that they like call them. Now you're going to see on a hard money loan somewhere between a 6 to 8% return because there's hard money lenders out there that will take your money, use your money, they'll pay you 6 to 8%, and they're lending it out at 10 to 12 plus 1 to 4 points. Okay, now a point is 1% of the loan amount. So if they're making a loan on a $150,000 house, they'll probably go to 70%. 150,000 times roughly 70% is roughly around 100 grand. You got 100 grand, great. Guess what? You're making 6 to 8%. You're not making any points. And basically you're into an asset for roughly 70 cents on the dollar. If they handle it, the borrower doesn't pay, then they go the foreclosure process and pay it back. Now, a lot of these hard money lenders, they're taking your money and putting it in a fund and they're lending it on a fund. So it's like a REIT there for you. Okay, which is not bad if that's something that you want to do. The one curious thing you have to be careful of is making sure, and this was a big sign to me in April of this last year when Harris County in Houston and Travis County, you saw a lot of these hard money loan lenders having to foreclose because of what? It got 26 to 30% more expensive to build a house. And the people that originally were on the loans did not have that calculated and nobody saw that coming, or they could not evict the tenants in there as they're rehabbing properties, whatever it might be. You saw some issues with that. Now you could go tax deeds, which a lot of people love tax deeds, tax certificates, that kind of stuff. The return on that's going to vary by state, whether it's a tax deed or tax certificate, if there's a redemption period or not. Usually across the board is about 12% or higher, depending on where you're at. In some states, it's higher than that, but you've got a 2-year, 3-year redemption period. So you have to know each state's a little bit different. And of course, you got to go up, you got to show up at the auctions and see what's going on with that stuff and do a lot of work on that stuff as well. Non-performing notes, what we've cut our teeth on the last 15 years. You are seeing a bigger discount. Okay, we're not paying 90 cents on the dollar like a lot of people are over financing stuff. They're usually with a non-performing note, depending on what state you're buying those in. It's going to be somewhere between a 12-month and a 36-month. Like if you're buying in New York, it could be a 36-month foreclosure process. It may take you a few months to get the borrower back on track, and then you've got 12 to 15 months of 12 months or more seasoning. So you're looking at over the 12-month period. Like, can be great returns, but you've got to be hands-on with it. You got to know what's going on. You've got to have the vendors in place, and you got to be willing to communicate and take some time on your schedule. And we have plenty of people that are doing non-performing loans in their spare time. But what happens at a point of about somewhere around 15 to 20 notes, you've got to get rocking. You've got to really bring somebody on to help you out with it. And some people are like, oh, I don't want to create another job. I'm tired of toilets, tents, and trash outs. I don't want to do that. And that's fine. I didn't put rentals up here because a lot of people I don't want to do rentals. It becomes more of a bigger job for them. See, somebody asked a question here. Yes, there is this is all. Yeah, had another meeting that just ended. Yes, you can catch this replay by going to weclosenotes.tv, Anthony. weclosenotes.tv. If you're registered for it, you'll get a link out to this tomorrow anyway. So, non-performing loans can be great returns, but like I said, it can be a lot of work. And if you don't have the time, you're juggling another job, and you don't want to do a lot of work, guess what? There's another option for you. And that could be basically the performing note side of things. Performing or re-performing notes. Now, a performing note is exactly like that. It's somebody who's paying on time, is always paid on time, might be a little glitch here and there, like, they're 7 days later, not really late, but a performing note is basically on time. Now, a re-performing note, which is what we do a lot of, is we buy a lot of non-performing notes get them back on track and making payments for 12 months or greater. And they've paid on time for a longer year, usually paying extra per month or putting a lump sum down to reinstate or modify that loan. It's really great. And we love it because it is a pretty good return. You could buy performing notes straight from like Fannie and Freddie for a 3% return if you want to make that. But you can also find deals out there if you're out hunting down for the deals somewhere, 8, 10, 12% as well. Sometimes higher on the reperforming side, depending on what's going on, but we like to set realistic expectations there. So you could buy all day long at 3% right now. I guarantee we could find you millions and millions and millions of loans out there because a lot of loans are being originated that amount, and banks and brokers are looking to sell stuff off at par, close to that. But the reperforming side, we've seen stuff, like I said before, where a borrower came in, not a borrower, but an investor came in, bought a non-performing note, worked it. They want to sell it now to reinvest, get their capital back, what they put into it, plus some of their profits to go out and buy 2 or 3 more. And they like that double down effect. I love that. We do a lot of that, but we also buy a lot of reperforming notes and performing notes too. And the beautiful thing about this, it's really like investing on autopilot. All right. You have a third-party servicing company who's doing the collections and mailing out your payments to your LLC or your IRA account. They're doing all the paperwork. If there's any questions, the borrowers are calling the servicer. They're not calling you at midnight. I mean, nobody ever called the bank when their air conditioner broke, right? Nobody ever called Bank of America when little Timmy's rubber ducky got flushed down the toilet and now your bathroom is now a river, okay? A non-performing loan. What is an estimated ROI? BS. A non-performing loan, well, that will vary because it depends on which way it goes. Your biggest number one thing you're trying to do in a non-performing loan is try to get it reperforming. So we will take basically the P&I, principal and interest payment, times 12 months and divide that by the purchase price to get a rough estimate. Now, a non-performing loan, we're not usually doing anything that we're not going to see at least somewhere around an estimated 15 to 25% return on the get-go. Now, that will vary, obviously, as we get deeper into due diligence, but when we're looking at spreadsheets, that's kind of what we look for. If you're willing to do the work and learn how to do this stuff, yeah, you can make good returns, really nice returns. It's just more work than a reperforming loan. Now, non-performing loans are not for everybody. Some people are like, oh my God, I don't want to do all that work. I would rather just write a check and invest in an autopilot. And that's fine, totally fine. There's ways for both of you, those types of individuals to do it. But what happens for a lot of folks out there is a lot of folks aren't getting into the market because A, they're not looking at deals. They don't think they've got enough money. They're looking at their retirement accounts or their IRA accounts that they've rolled over, like, I don't have anything I can put to work there, or I can't go buy a property because I just don't have the 100 grand or 200 grand, or I don't have the $500,000 in my market to get a doghouse if I'm living in California, stuff like that. So I wanted to bring this up. I've never talked about this before. I mean, I've talked about it briefly, but we've got some opportunities. And after looking at the market and seeing what we're seeing out there in the market, we see opportunities for some of you guys that are looking to make 6 to 8% on autopilot. We really do see a lot of opportunities in that mid-level market. It's keeping up with inflation. It's getting your money. You're not losing money on it. You're keeping up. And we see a lot of people who don't want to do the work, or they can't do the work, but they would rather gladly make 6 to 8% so their money's not losing them anything on a monthly basis. And we come across performing loans that have never been late. We also come across reperforming loans that have at least 12 months of seasoning. And seasoning means they've been with a servicer for at least 12 months, whether it was newly originated or been reperforming for at least 12 months out there. And we see some pretty good deals. We've been working on with a client of ours here. I don't know, is she on here? Maybe she's not on here tonight. But we've actually working on looking at buying a portfolio of over 300 performing loans. There's some smaller value stuff on that, but we've got some investments from people that can be putting $5K to work to over 100 grand plus to work, making a good ROI basically on autopilot. Now, a couple of things about how do we do it? Well, it's a pretty simple process. We have our, I can say our nose to the grind, so our ear to the ground, and we get deals sent to us all the time. And we come across a variety of different funds that send us stuff that we can take down. We see this stuff happen all the time. And we get portfolios sent to us that people are underbidding because I got to do all this extra work, or my money cost me 12% or 10%. No. What we do is we find these portfolios, we find these performing notes paying above a 6 to 8% return. We put it under contract, put it under an option, you put it under a loan sale agreement, And for those that are interested, we then reach out to our investor database. We reach out to the investors out there that, hey, I've got some funds, or I'm looking for something that's reperforming. So what do? We turn around and we'll sell that note to you in your LLC or your self-directed IRA. And we'll make sure, based on after servicing costs and things like that, that you're seeing at least a 6 to 8% return on investment. Now, then, let's say the note's paying at 9%. Well, we'll deduct our fee off of that 9%, where the UPB is, where the balance is, and we'll still make sure, based on the numbers, that you're getting a 6 to 8% in there. Maybe the note's paying 10%. We'll deduct the 2 points off that to make sure you're getting 8%. Okay. So we will find the deal, break down and do the due diligence, give you the due diligence to review it for yourselves. And if you're ready to go, we'll basically sandwich ourselves in the middle, basically wholesale you the note, sell you the note. A third-party servicing company will handle the payments, the statements on this stuff. They'll be set up there so that you are basically, your money starts coming in on a monthly basis on the 5th or the 15th of the month, depending on when the servicing company sends a payment. And that's the beautiful thing, is if the borrower has any issues, they're calling the servicer. Now, a lot of people are like, well, Scott, what if happens if if the borrower goes late? Well, the beautiful thing is that we're going to be buying these, and we are buying these below the fair market value. So there is a bunch of equity above what's owed, and also at usually a little bit of a discount in unpaid balance, so that if you do have to foreclose, you're going to be made whole at least at the foreclosure auction. If not, taking the property back in a deed in lieu of cash for keys and be owning an asset that's a lot more valuable than what you invested in. We stay involved. My team, my staff is not, I don't own a servicing company, but I've got staff members that used to work for Madison Management. They handle our portfolio. We'll stay involved in case something happens with the borrower. If you need somebody to start being more aggressive in the outreach, if the borrower does go late and the existing servicing company is not doing well, part of what having a servicing company is, if it's a performing note, they're only charging you $15 to $25 a month. If it's a non-performing, they're going to be charging $90, $95 a month, which obviously can eat into profits, especially if they're not paying. But we get involved on that. We'll stay on top of the situation for you and make sure that you're made whole and taken care of. But like I said, we don't own the notes on these. They'll be set up in your LLCs, your IRA accounts. You're actually purchasing the deal. We're basically taking a wholesale fee off the top to help put an investment together for you. And, in a variety of different states and cities, stuff like that. But we got some different opportunities that are available right now. One of the things that we're requiring is making sure that either the tax and insurance are escrowed or the borrower is paying that and providing that to us before ever funding. And we want to make sure the insurance is paid and that also the taxes are paid or escrowed in for that for you. And a lot of times your servicing company will keep an eye on that for you as well for you, depending on what servicing company you use. And there's a variety out there. We can use any self-directed IRA account as long as a truly self-directed IRA trustee or custodian. We would not recommend funding these in your name. All right. So we are going to require people that be using their LLCs to do this. And like I said, we're glad to help you identify opportunities going to pay you a 6 to 8% return on investment, depending on what's going on. So if you're interested in getting some more information and learning how to beat the bank, getting more than that 0.7% or that 0.19% or the 0.06%, and your money's burning a hole in your pocket, or I should say it's literally evaporating based on inflation, anything like that going on, give me an email. Shoot me an email at scott@weclosenotes.com. If you've got $5,000 or more, we can usually we've got some opportunities that are short term on some of those lower amounts that we're working through. And then also, if you've got bigger amounts, we've got some opportunities to help put a decent return in your pocket where you don't have to do a lot of the work. You just basically need to evaluate and make sure, hey, yep, that looks good. I'm comfortable with that. And you're rock and roll. And then once again, you're not by yourself. There's a servicing company to help you out there. And if you need to, we're glad to jump in the fray and get involved as well with the bargain back on track. So if you'd love to talk more about this, schedule a call with me at talkwithscottcarson.com. That'll take you directly to my schedule, to my calendar. I'd love to visit with you 30 minutes, talk about it, see what you're looking to do, what kind of funds you're looking to put to work. Here's the thing, ladies and gentlemen, if you've got money sitting in a savings account, a CD, an IRA account, and it's not making money, it's just sitting there waiting for you to pull the trigger, you are losing money. You choosing not to take action is actually causing something to happen. You're losing more. Fees being deducted annually from that, and you're not making any money on that. It's time to put the money to work. And if you're not going to do it, hey, that's fine. It's totally up to you. You want to go out and I'm going to go find the stuff myself. That's great. But feel free to give me a phone call. I'd love to talk with you and see if there's a way we can create a win-win scenario for you. So we do have opportunities right now for you to get investing in. Actually, some performing notes have been performing over 36 months. that are yielding a very, very good, was it 7%, 8% return? Borrowers paid on time for several years, and it's a great opportunity for you to make a real good return. And you don't need to have, I think one's a small $15,000 unpaid balance on the value of a property of over 80. Another one I think is 25, and the value of that property is 70. So anyway, those are not my deals, actually. Those are from somebody else. Another investor came to me and asked me if I'd be willing to help him move these two assets because he's trying to close out an LLC and move on. So love to talk with you. If you have any questions, are there any questions from you guys tonight that are on here tonight with me? Here to help answer anything I can and help you put your money to work, guys and gals out there with a variety of different opportunities. That's correct, Tony. Yeah, your EIDL loan has to be used towards paying your payroll. That was one of the things we took a loan out as well. I think if you use the emergency loan, that's got to be paid towards your payroll and making sure whether you're paying yourself or you're paying your staff. So I agree. I looked at that as well too, because when we got, I was like, if we use it for something else, we got to pay money back on it. If I'm going to use it for payroll to keep people employed, I don't pay any taxes on it. So yeah, but something to think about as well for you. You've got other funds and stuff like that sitting out there. Okay. One other question here. We already answered that question. Okay, great. Any other comments, concerns? Everybody out there? There, we got another question here. Used to be bigger numbers on West Coast upper. Thomas, I'm not sure. I'm not sure what you mean. Used to be bigger numbers on West Coast upper ranges. I don't know what you mean by that, Thomas. Robert asks, is anyone packaging these ups for larger investments? You could do that. There's some things. We're not taking these individual assets and portfolio them together to sell them to Wall Street. No, we're not doing that. We are actually, I have a conversation with a big fund tomorrow about putting a fund together just for us in that aspect. I have a fund that we're working through right now, but there's also a fund to come in that would leverage what we raise to give us 2 or 3 times the amount of what we would raise to go buy bigger deals. And I'm pretty stoked about that. But you could, there are companies out there that are looking for, I'll give you a great example, like a BK Chapter 13 portfolio. There's some funds that are looking for BK Chapter 13s because they're on a payment plan. They like to pull them together. Like I said, our buddy Jack Krupe had a fund that he ran that way. It was a $150 million fund that just bought that itself. But what you see, a lot of these big REITs and big funds, they're looking for that $150,000, $200,000 valued asset or greater. And when they wrap it together, we see a lot of opportunities in that sub $150,000, $100,000 markets, which is great ways to get involved in some either performing or non-performing notes that fit a lot of people's categories there, especially with their IRAs. Jerome, can one get into the note buying business creatively with little to? Yeah, I mean, Jermon, sorry, yes, you can. There's so many ways to. I mean, there's so much private capital out there on the sidelines not making anything. That people, we've 95% of what we have bought in the last 14 years has been using other people's money to buy, and there's a lot of money sitting on the sidelines making zero that would gladly pay a flat return, 4, 5, 6, 7%, while you're going out and doing other things with that money. I mean, other things be like buying notes and using money to find that stuff. So yeah, a lot of money out there. You don't have to have a lot of funds yourself to dive into. That's part of what we'll talk about actually during our one-day wholesaling class in a couple of weeks, how to convert those potential wholesale buyers into funding sources for you in the future. So any other questions, comments, concerns, ladies and gentlemen? If there's not, hey, once again, don't forget to check out our one-day wholesaling masterclass, Saturday, March 5th at 9 a.m. Central Standard Time. If you go to wholesalingnotes.com and get signed up. So we got to get signed up at wholesalingnotes.com. Use the code NNA to get it at half price. Anthony asked a question. Do you buy non-performing notes, and at what sort of discount? I have 2 at around $75K. I'd have to talk to you, Anthony, take a look at where they're at. What's the equity on those, if there is any equity, and how far behind they are. So feel free, schedule a call with me, Anthony, at scott@weclosenotes.com. That's scott@weclosenotes.com. That's take you directly to my calendar. I'm sorry, talkwithscottcarson.com. Type it too much then. Or schedule or drop me an email at scott@weclosenotes.com. And I'll be glad to talk with you about your 2 deals and what you have that you're looking to get rid of here. Thanks, RJ. Good to see you, buddy. You're welcome, Shelly. You're welcome, Larry. Everybody, get signed up today for that one-day class. If you have any questions or looking to put some money to work, reach out to me. I'm glad to talk with you and help get the ball rolling for you. Otherwise, everybody, thank you so much for coming on Note Night in America. Hope it was valuable for you. Take the information and use it. Put it to work for you. The biggest mistake that people are making is inaction. That's the worst thing you can do, because if you take inaction, you are losing money. All right. It's time. You've got to step up and do something. Either A, bring somebody aboard to help you put that money to work, or go out and start hunting and killing yourself, because every day that Benjamin gets weaker and weaker and weaker and gets nibbled and nibbled and nibbled and nibbled. You have to do something now. Otherwise, you face not having anything before too long. So thanks again for coming out tonight, everybody. Note Night in America every Monday night at 7 p.m. Thanks, Jermon. Thanks, everybody. Be safe, and we look forward to seeing you all at the top, everybody. Bye. And those on the live stream, I forgot to check YouTube there real fast. RJ, you snooze, you lose. Amen to that, brother. Amen to that. Let's see what we got here. We got some people watching here. The questions on here. Craig Kilbro, hey, let's go, baby. Good to see you, Craig. Dimitri, good to see you there. Hey, guys, good to see you both visiting there. You guys were people in the classes last weekend or 2 weeks ago. So be safe, everybody. Have a great